The main topic of discussion today is a very interesting one. It gives out a lot about the line of discussion we will have. Optimism or exuberism. So that is the main topic of discussion this evening. So let's take a quick view or opening comments on the scale of optimism and exuberism. Where do we stand right now, the market? And not, why only Indian market? We'll come to Indian market. There's been a massive rally globally in the last, from the peak of pessimism at the COVID lows, and now new factors are getting added in. Now people are talking about rate cut, all of that globally. Where do we stand, Sailesh, in your view, on that scale of optimism, exuberism, complete pessimism? We have rebound from there. Your opening thoughts.
Thank you, Ajay. See, internationally, there are so many moving parts that it's very difficult to say where it stands. It's clearly, it means that the volatility reflects, or at least the unidirectional movement reflects that clearly a lot of it is getting thin. We don't know the degree of it. And neither does it reflect on the fact that it will immediately correct. None of these lead to that conclusion. In India, clearly we are finding that expectations are running very high. And I think, so whether we are in terms of scale where we stand, but clearly we are getting into a zone where you touch a stock, it goes up. You don't need to read about it or invest or whatever, or you think about it, it goes up. So that is a reflection of, I would say, starting of excesses, which is there now for the last few months. Money flows are unidirectional. Everybody's turned into, or everybody has a stock idea today. So clearly we are getting into that zone. And that is where I think a little bit of risk averseness will help all of us.
Great. You are spelling out caution. That's a great starting point. Vasu, just to put the global things also in perspective, from the peak of pessimism, COVID lows, there's a lot of things happened. Geopolitical issues, in the Middle East, slowdown issues in the US. China is not doing that great, but markets globally have been climbing, not all markets, but largely this wall of worry. What do you make of the backdrop, global backdrop in which India is operating right now?
I wouldn't have been able to predict this if you had asked me this question.
Say 2 years
and if
back.
you had 2 years back, and if you had told me there's going to be a war and all the uncertainty and rates would have gone up to like 5%, I would have definitely been negative on markets. So I think the only thing that explains it, I guess, is the huge liquidity around.
Because I don't remember a time when war is going on simultaneously, market is running globally. As if everything is getting priced in. And, the global asset classes are moving in individual silos, and a war in the Middle East did not really impact for a prolonged period of time. It did impact for some time temporarily, but then market moved on. So how did you react at that time? And were you also, your model also kind of, you got surprised?
So it's easier for us to be very honest. So we are relative return investors. So we really don't bother about where the market is going largely for a very large part of the portfolio. We just put our heads down and try to figure out what stocks or sectors will do well within that frame. So that makes our job easier. But having said that, we do have a market timing model on which we run a dynamic asset allocation fund. That model has been negative on equities for like the last 18 months or so. And by and large, I would say that model has gone right because the underlying for that model is the Nifty. And till the recent rally, Nifty really hasn't gone, it's done like 5%, 6%. But what has really done well is the stocks down the capitalization curve. And the model doesn't try to predict that because the data there is not clean enough. And the model has been negative because while earnings are good, so we basically look at 3 factors: valuation, earnings, and sentiment. Earnings are fine. I think they're better than expectations for sure. Valuations, we look at something called the Shiller P. We look at the inverse of the Shiller P, and we take out bond yields from it. So that's somewhere in the 77th or 78th percentile. And when you kind of regress that with 3-year forward returns indicate an equity risk premium of like 1.25, 1.3%, which I think is not good enough. You need closer to 5.5%, 6%. And we also kind of put sentiment on top of it. So the sentiment index we run correlates very well with 1-year forward returns. We do that to because markets tend to overshoot on the upside and on the downside. So you want to kind of time it right. So this model has been negative. It also, the extent to which it has been negative is, so on a 50-50 benchmark, it's been 20% underweight equity. And I think it's been fine so far. So I would say that to that topic, optimism or exuberance, right? So I would say that large cap space is probably in an optimistic zone, whereas I definitely think that the small cap, the micro cap space is quite exuberant.
Okay, so you're breaking it down in two parts and approaching the market.
Because that dispersion is very visible.
Very
so small cap index is done 50%, large cap is up like 17, 18%, 32% outperformance in a year. So,
Naren, the speed at which global fear turned to greed, when we topped out, say, 107 on the dollar index globally, or yields, from the recent peaks have fallen below the 4% mark. Were you surprised at which the sentiment globally also changed? That also gave a very big kind of boost to Indian equities.
Certainly, I think people have come to a conclusion equity is the only asset class which people like today. First of all, it's a liquid asset class. You can easily come in and come out. Yeah. The trading engine is very good.
You're talking about global?
Yeah, even globally. So somehow what has happened is that people have found it very comfortable with equities as an asset class. And I think globally there are too many people who have short positions in too many stocks. So what happens is that periodically the shorts get squeezed. And that also results in huge rallies these days. There are these CTA funds globally. I think those funds manage to squeeze out all the shorts periodically. So I think, there is all kinds of market positions these days, things which we don't know about actually. And that has resulted in a situation where it has become very difficult to predict markets at this point of time. And the kind of whipsaw moves that you have on small differences in results are something which you would have never expected way back, because of the fact that you have what kind of short position, who has the short position, we don't even know. And that is, so that's why I would say yes, we have been surprised, but we have increasingly got round to the view that there are a lot of people for whom this has been a long bull market in US. All the way from 2010 to 2021. So I think a lot of people believe in equities as an asset class. Even in India, if you look at it from 2013 onwards, most people have not seen losses. So people believe in equities as an asset class. So the confidence in equities is at a record level that people don't want to leave the asset class. So periodically what was trading at X.
So what people were trading at one point of time, they have actually changed. So slowly every P, what you were giving XP, you started to give 20% higher valuation. Now slowly you're giving 30% higher valuation. You're giving 40% higher valuation. I think every other boom continues, you'll give higher and higher valuation. So then the market boom can sustain.
What is your view on this argument which comes up that some of the reason for India's strong outperformance is actually because of the superior economic growth over here and structural reforms which have been taking place versus many other large liquid markets globally?
Absolutely. I think the macro has been handled very well over the last decade. If you look at current account deficit, for example, has been very well behaved. Inflation has been very well behaved. The interest rates in India are much lower than where they were 10 years back. So on all those counts, there is an argument for value for the entire macro to be good. While macro is good, increasingly, to what extent you will pay what valuation. Because if you look at many parts of the economy, there are many sectors in the economy which are growing much slower than before. But while those sectors are growing slower, you're giving now higher valuations. So yes, the macro is good, but how much extra valuation you'll give for the macro? That is the challenge that we as investors. So to the extent you can forget the past, it's easier to manage money. And how much you forget the past, because finally the past will come back. So that is the challenge that we have when we have to look at investors' interest when you are managing the money.
Yeah, and they say about history that the only thing we learn from history is that we don't learn anything from history.
Exactly. So if you ever had a mindset of looking at a company with a pre-2013 lens, it would be very difficult to invest in any stock. So you have to have a new lens. Whether that new lens is a wrong lens or not, you'll come to know, and that's the challenge for us at this point of time.
Sailesh, what happened was that from a time, say 2 years back, there were some economists out there who were saying that India will be lucky to have 5% kind of growth. The kind of numbers which we saw surprised majority of the investing population in universe. Does the economic growth which we've been posted in the last 2 quarters, say, does it appear sustainable or prolonged to you?
Clearly, growth rates are improving, right? So the debate on valuations is more that whether that all that
How much
growth
of that is priced in?
Yeah. So growth rates are improving clearly, and despite the world being in bad shape, we are coming back. Only worry is, the revenue growth hasn't kicked up so strongly. It's more coming from margin expansion, from generally sharp fall in raw material prices versus what was the case 12, 18 months back. So the base effect is flowing in. As revenue growth starts kicking in, which I think is possible in the next 1 or 2 years or a few quarters ahead, I think things should get okay from a growth point of view. But we are already paying for, at least in a lot of pockets, like, the small and mid-cap kind of sub-pockets, we are certainly paying well. So there cannot be any room for error. There cannot be any disappointment, which is, see, today it's a belief of certainty. So investor is writing a check with a certainty of returns in mind, or at least the expectations are a little unreal. So that is where the word of caution. Broadly, markets can still do, earnings can still do well and things like that. That's not a problem so much because balance sheets are good, reforms have happened, macros are decent, our currency is not fragile, at least as it used to be earlier. So it's much, much better from that angle, and the runway for growth can certainly be long, but I think we are paying a little too
Already
upfront because of the
price.
flows which are happening.
Also, what are your thoughts on, two largest economies in the world? And, we have been kind of at the receiving end of volatility in commodity prices for a very, very long time. Corporate India suffers from it. We as consumers also go through those challenges. But the two large consumers, apart from us, for commodities have been US and China. Both of them are in not great economic shape. Does it give you confidence that the commodity universe will remain in deflationary trend for medium term? Because that eventually will have impact on the raw material scenario for corporate India and hence will kind of cushion margins. China and US.
That is definitely one way to look at it. But we're actually bullish on commodities from a longer term perspective. Basically, the long term view is that because of the high debt to GDPs across the world, you are entering into a phase of, or a period of financial repression, and negative real rates will be positive for commodities.
The point I was scratching a little about earnings outlook for corporate India. What is the early sense you're getting? Naren, let's come with you. The kind of Q3 updates we're seeing, early conversations, some of the banks, large banks have already given numbers, some NBFCs.
It is fine. There are consumption-oriented areas where we do believe that the growth will be a bit muted. But you can see what happens is today we are a very well-researched country. So even if the earnings come slight beat, you can have huge moves. So what happens is many of the things are actually factored in. By the time the results come, we have already factored in the negative news. So what happens is it's tough. What is factored in and what is not factored in, and that becomes the more interesting aspect. So if you looked at some of the results which came yesterday, I mean, if you just put the results without knowing what was factored in, the reaction could have been different. But if you had looked at the result after knowing that this was also factored in, then the reaction of today would have been, what happened was everything was factored in.
Fair point. I mean, market kind of starts working with a number, expectation number, and then it compares it rather than what the reported number was actually. But what are your thoughts on valuations? Is it right to look at the index valuation and take what is the earnings per share which is being expected and where it lands up? Is it the right way to aggregate and take a call on valuation of the market?
Basically,
point was, see, 3-4 years back, what was happening was there was a huge dichotomy in valuations. And that dichotomy in valuations was very easy to be exploited. So you had sectors like, let's say, metals or telecom or power or PSUs, which were trading as though you are in a different country. And then you had some quality stocks which were trading as though you are in a 10% or 15% GDP growth country. So for people like us, it was very easy to choose a set of stocks over another set of stocks. Similarly, at that point of time, even many of the small caps were also trading as though we were in a low growth environment. Today, what has happened after a big bull run for the last 3 to 4 years, almost everything has got rerated. So it puts a lot of confusion, what is already priced in, what is not priced in. And the so-called quality stocks which were appearing very, very costly 3-4 years, they have been the dogs in the last 3 to 4 years. So now the debate is, should you actually look at them because they have not done well over the last 3 to 4 years. So the stock picking part of it was very, very easy last 3 to 4 years. Now the debate, what some people say is, yes, you have not had a capital goods cycle for the last 10, 12 years. Now you'll have a capital goods cycle for the next 5 years. So bet on it. But some of those stocks are already pricing in many of these things. So the debate is whether we'll have a massive capital goods cycle, that you shouldn't look at valuations at all. So there's a debate which is confusing from some points of view. Then that's where it's much more confusing than 3-4 years back.
Sailesh, do you get the same confidence of stock picking or taking a call which end of the market is clearly undervalued versus which part is not, say 2-3 years back versus now? Are you also facing the same conundrum as Naren?
See, the advantage 3 years back was very, very clear. I mean, you could easily distinguish. It was generally a one sector bull market and rest of the others were down. So out of 10 sectors, 9 were doing badly or 8 were doing badly and one was valued well. So you could clearly move around, right? Today it's got reverse. 7, 8 or 9 are getting valued well, right? And whatever money also is coming into now equities is generally coming with higher expectations the last 3 years. So this is the challenge. So there's no easy picking. And unfortunately, it's moved to relative valuations as the only decider for taking a decision. It is moved to, these kind of markets are also leading to a little bit of misallocation of capital in my mind, when you look at how investors are putting money in.
That's a great point you made, that if stock selection has come down to 80 P is looking cheaper because the other guy is looking 100 P, then perhaps we are, moving away from the principles of, investment management which we learn at CFA or CA or whatever. Vasu, what are your thoughts on this?
About buying an ADP stock?
No. well, you must be holding many of them. But, relative valuation, has come down to, the choice has to come down to which is looking relatively cheap versus in isolation, whether this sector's, how much of the earnings growth, visibility or runway is a sector actually pricing in or not.
Yeah, हम लोग relative game में ही हैं, honestly.
Wow, so are you telling that the right prudent strategy in this kind of a market, in the environment which you have drawn, is no, I'm sure you want to take your words back, but to have moderate return expectations?
So let me put it this way. As an investor, you should think obviously in terms of asset allocation. So there I'm making it very clear that we're negative equities. That too from a relatively short-term perspective. When I say short-term, I'm talking of 1 to 3 years.
1 to 3 years, one should be
negative equities.
Negative equities.
20% underweight equities. That is the view, right? That view is very clear. Now, the problem with that kind of a view, and investors should do that, let's assume, right? Let's start with that presumption. The problem with that view is that you have to make up for that carry on equity. So equity, aaj ke din mein bhi, I think, will probably give 9-10%, which is not good enough. You want 13-14% for that risk.
The premium over risk, yeah.
Correct. And what do you get on debt? So that 2-3% that even the on expected return is something you need to catch up on market timing, which is like a low probability outcome. Now, having said that you have to be, let's say, 40% equity or 60% depending on your asset allocation, then you just go and find the best stocks out there and not worry about what is going to happen over the next 2-3 years. Matlab, over a longer term perspective, this is the only asset class I think will make money.
Which Naren was also kind of, that's the thought process.
And despite all the ये market timing वगैरह सुनने में इतना अच्छा लगता है, talk about earnings, valuation and regression and all that. I don't do any of it. 100% of my money is in equity. So this is one way to look at it from a long-term perspective. There is another way to look at it from a relatively short-term perspective. And you manage your asset allocation and then not really worry about, think in terms of relative valuations again. So if valuations get really expensive, so again, I'm making it very clear, right? We are 20% underweight equity. So we are not that, and the model kind of lets us go 0% equity. We are not there yet. We are not even at 40% underweight. So the market is clearly not as expensive as at least this conversation is making it out to be.
We'll get there when you go completely no.
So then you kind of go 0 on equity.
We haven't reached there yet.
Definitely not. So 20% ठीक है.
How much of this role, Naren, the liquidity which is coming in from retail investors? I mean, the recent data, one of the big AMC's con call I was listening to is saying that massive inflows from B30. And so what do you make of that? I mean, 18,000 crore is the SIP number, 3,000-4,000 crore was the number, say 4 years back. And it may have upward bias the way things are. So this money is not looking at valuation.
See, people think it's only mutual funds, but you have to look at mutual
AIF,
fund, you have to
PMS.
look at NPS, you have to look at TPFO, you have to look at direct equity. And the way the derivative market is shaped up, that is also very important. So what happens is, this is a confluence of many things, and that is the challenge. And having seen early 90s, in the early 90s, we had a set of investors who came in who didn't understand risk of equity. This time also, there is a set of investors who could have come after COVID, who have only made money, who may not have seen all the risks. So that is a challenge actually, because we don't know whether they understand what is the risk of equity. When we tell people that there is something called risk in equity, how many people understand that? So we tell them do asset allocation, like Vasan said, but how many people understand asset allocation? They say, yeah, debt kya hai, boring, it's boring asset class. How much maximum return can you make out of debt? So what is this asset allocation nonsense you're saying? Equity is such an interesting asset class. Every day you may make money. So this is the challenge that we are facing at this point of time. And unlike other countries, we have never had a setback in recent times. So the more and more you don't have a setback, the more and more people think that the risk in equity is lower. And that actually leads to what Minsky said, no? The more and more people don't see a setback, people think equity is safer.
Yeah, the
Till
bull
that
run
final
babies
day.
you're talking about.
Yeah, so
Those of them who have upped their game in equities in the last 3-4 years and 25% CAGR kind of portfolio return.
yeah, that's why if you look at derivatives, stock future, open interest, you look at the kind of volumes which take place in Nifty and Bank Nifty, all that is all happening because people think it's a low risk game. They say you're old, that's why you don't understand the risks involved. You think that equities carry risk, but we have seen 90s, we have seen 2008, we have seen 2011. So those risks people don't want to see at this point of time. That is the challenge, and till the risk plays out, people will think that the risk will never play out.
Great. So, gentlemen, thank you very much for your time. I think I've been indicating that our time is up. But the gist of the entire conversation is clearly we are in shades of exuberism. So, the idea should be to be prudent right now with your portfolio strategy and not get carried away. I think that's my personal takeaway from talking to all three of you. Vasu, Naren, Sailesh, thank you so much for your time. And CFA team, thank you for inviting us.